Warren Buffett, he doesn't just throw darts at a board. He has a system, a checklist. So today, we're going to do something fun. We're going to take that very same checklist and run a real company's financials through it. Let's see if we can spot what a master investor would see.
So let's try to get inside his head and ask that exact question. Now, I gotta say this right up front. This is not investment advice, okay? The whole point here is to walk through a process, a framework for how you can look at a business using its own numbers.
And our guide for this is Buffett's super simple but really powerful 3-step checklist. We're going to apply it to a company called Arch Capital Group. You'll see it as ACGL, and just see how it measures up. It's a framework that really boils down to one simple goal. Find a fantastic business, but don't pay too much for it.
Okay, first things first, step 1 is all about finding a wonderful business. And for Buffett, that almost always starts with a proven track record. He loves companies that have been winning for a long, long time. So let's kick things off by looking at the long-term returns.
Wow. Just let that number sink in for a second. Over 1,200%. We're not talking about just growing your money. We're talking about it multiplying over and over again. This isn't just a one-hit wonder or a lucky year. This is our very first big clue that there might be a really powerful engine running inside this company.
And check this out. It wasn't just one lucky decade. Look at the 5-year, the 10-year, heck, even the 20-year numbers. It tells the exact same story. Consistent, powerful growth. This is that magic of compounding that you always hear about, and believe me, this is the kind of long-term track record that makes an investor like Buffett sit up and pay attention.
Okay, so a fantastic history is a great start, but a wonderful business can't just rest on its laurels, right? It needs to be a profit-making machine right now. So that brings us to the next big question. How good is it at actually turning investors' money into cold, hard profit?
And to figure that out, we're going to use one of Buffett's all-time favorite metrics, return on equity, or ROE. The easiest way to think about it is like a report card for the company's managers. It answers a really simple question. For every single dollar we, the shareholders, have invested, how many cents in profit did they make for us?
And here's the number for Arch Capital, a really solid 18%. Now, as a general rule of thumb, anything over 15% is pretty darn good. It's a strong sign that you're looking at a profitable business that knows what it's doing with its money.
But there's always a but, isn't there? High ROE can sometimes be a bit of an illusion. See, a company can juice its ROE by taking on a ton of debt. It's like building a skyscraper on a shaky foundation. A truly wonderful business is profitable and financially solid. So we've got to check the balance sheet.
And boom, there's our answer. A debt-to-equity ratio of just 0.11. I mean, that is incredibly low. What this tells us is that the awesome 18% ROE we just saw, it's the real deal. It's not pumped up by risky debt. It's built on a foundation of solid rock. This is a massive green flag for a value investor.
Okay, so let's recap. The numbers so far are pointing to a high-quality, financially strong business. Step 1 looks pretty good. But now we hit step 2, and this is just as critical. Because like the old saying goes, even the most amazing company on earth can be a horrible investment if you overpay for it.
So, how do we check the price tag? Well, a really common way is to use the price-to-earnings ratio, or PE ratio. Look, it's not the be-all and end-all, but it's a great quick and dirty tool. It gives us a snapshot of whether the stock looks cheap or expensive compared to the profits it's making.
All right, so ACGL's current PE is about 8.4. But a number by itself doesn't mean much, right? The really interesting part is when you compare it to its own history. It's actually trading for a lower PE than its own 3-year and 5-year averages. What does that mean? It suggests that today, you're getting a better price for each dollar of its profit than people were willing to pay, on average, for the last few years.
And that leads us perfectly into our final step. And honestly, this might be the most important piece of the entire Buffett philosophy. It's the one concept that really separates true investing from just gambling, and that is the margin of safety.
This whole idea came from Buffett's teacher, the legendary Benjamin Graham. The best way to think of it is like buying something on sale. It's the difference between what a company is actually worth, its intrinsic value, and the price tag you see on the stock market. That gap, that's your margin of safety.
The bigger that sale, the bigger your buffer, the more protection you have if you're wrong about something. So if we run the numbers using a standard valuation model to estimate that intrinsic value, does Arch Capital look like it's on sale? Well, the analysis suggests the answer is a big, flashing yes.
And here it is, the grand finale. An estimated margin of safety of over 75%. I mean, that is huge. What this is saying is that the stock's current price could be trading for just a fraction of what the analysis suggests its fair value is. That gives you a massive cushion, a huge buffer, just in case the future doesn't play out perfectly.
All right, let's pull it all together. Let's do a quick recap. We ran through the checklist, we looked at the real hard numbers, and we tried to put on our Warren Buffett glasses to see this company. So, what's the verdict?
Well, based on our quick dive into the financials, it looks like it takes all three of Buffett's major boxes. We've got a killer long-term track record, we have strong profitability that isn't propped up by a bunch of debt, and it seems to be trading at a price that offers a really big margin of safety.
And that brings us to the most important point of all. Everything we just did, it's like driving by looking only in the rearview mirror. It tells a compelling story about the past, but investing, that's all about the future. These numbers tell you where this company has been. The really hard part is figuring out where it's going. So I want to leave you with a final thought. After seeing all this, what is the one question you would absolutely need to answer about this company's future before you could ever feel confident about its next 10 years?